keep on joining. In the meanwhile, we will start with the session, and let me take a moment to introduce our guest for today. So today we have with us Mr. Siddharth Rastogi, sir, a full-time investment banker with 21 plus years of capital market, financial market experience, and he has been associated with a leading asset management firm. So his specialization is in economics, capital markets, fundraising, people management, and the most important thing is behavioral finance, which we will be discussing in the session going forward. He is an avid reader and writer as well. So he's a regular contributor to Moneywise Magazine and Trademaker Magazine. So his like common title, Sage Siddhartha Speaks, is very popular, and those who are aware must be reaping the benefits of it for sure. And he's a motivational speaker and life coach. He has also authored the book that goes by the name of 8 Minute Decision, which helps with effective decision making. So decision making is one thing which from him we can condition that to our advantage. And as far as his educational background is concerned, so he is BCom honors from Delhi University, company secretary intermediate, and postgraduate in management from NMIMS Mumbai. So he has been meritorious throughout, and he firmly believes that the noblest way to give back to the society is to teach and impart education. So very warm welcome, sir. Just in case I missed out on your introduction, I would request you to add to it. And on the top of that, I would request if you are to your opening remarks on today's discussion point of discussion.
Right, Prince. So many thanks for having me. Namaste to all of you. बहुत बहुत धन्यवाद आप सबका to take your time out in the evening. Prince, you have spoken more about me. I am not worth that much. Whatever I have learned as of now, it's only blessings and good wishes from friends like yourself. So let's start the session. Today's session is all gonna be about Bharat. भारत की भारत की एक विकसित होती एक अर्थव्यवस्था. So India's economy and the rise of Indian economy and the India's journey to become the third largest economy, and then eventually by the end of the Swarnim period 2047 or 2050, India reaching its peak, India becoming the largest economy of the world, which is not new for India. It used to be till about 16th century. Despite multiple invasion, despite multiple plunderers, India resisted and India remained at the peak. After nearly 500 years, now is the time when India is going to regain the title. And all of you ladies and gentlemen who are listening to me today, have a golden opportunity. This is the golden era. As our Prime Minister, Honorable Prime Minister says, this is a Swarnim Kal, and that's what it's going to be. There's going to be no dearth of making money in India. The only thing is, when you are in a bullet train or when you are on a high speed highway, ensure that you put your seat belts so that you remain safe. So safety is always a priority, and that's what is the journey about equity markets as well. Over to you, Prince. Happy to answer and elucidate any questions you have.
Yeah, sir, exactly. I think like very clearly and loudly said by you, we all are very positive and long on India. And to start with, sir, so it would be interesting to know your investment journey. So how it all started for you and it has evolved over a period of time.
Right. So my journey with the financial market started roughly around 21, 22 years back. And I started my career with a very interesting firm known as UTI Bank. UTI Bank Merchant Banking. I was blessed to be in the debt markets, and me and a couple of colleagues of mine, we were blessed to do the first credit card receivable securitization transaction in the history of India. Post that, I got a lot of exposure with Citibank, and then I was with HSBC, where I dug my teeth further in the investments. I was anointed as the branch manager of the biggest wealth branch of the country. And then I co-founded IFL Wealth. And then for last 13 years, I'm with a leading investment bank. So this is the brief journey. What I've learned in my journey is very, very simple. If you look at consistency, and if you look at cleanliness as these two key factors to identify any investment opportunity, you will never go wrong. And remember, cleanliness precedes consistency. Cleanliness precedes consistency, because cleanliness represents the intent of the promoter. It represents the intent of the majority shareholder, how he wants to treat the minority shareholders. And if the intent is good, then look at the expertise, and expertise can only be evaluated through consistency. And that's what I've learned in a nutshell, in my last 21, 22 years of my investments career or market journey.
Right, sir. So normally when an investor starts his or her journey, the most difficult which they face, or rather say they struggle with, is where to start, right? So in today's time, there is too much of noise and too much of advice. So how to filter the quality information out of that noise? What would be your suggestion on this, sir?
A very, very interesting, Prince. So you are absolutely right. There's too much of noise, and one should cut down the noise and be wise to cut the noise. And how do you do it? Very, very simple. Remember one important thing in life, in business, and in investing. You have to look at data. If you want to change your life, start noting down how you are spending your time. If you want to change the business, start looking at where you are spending your money and time. And if you are investing, look at the data where you are investing, the businesses you are investing. So the first thing you should do is, please, please, please do not go by the hearsay. Do not go by your friendly neighbor's advice. Do not go by your chacha, mama, tau, uncle, auntie, friend advice, because they may tell you when to enter. They may also tell you that you will make money out of it, but they may not be able to tell you when to exit. That's number one. And number two, they themselves may not be aware of the underlying business which they are suggesting you to enter in. Remember, it's your hard money, it's all your hard earned money, and hence you have to work little bit harder to generate more money out of it. If investing would have been such an easy game, if it would have been a cakewalk for everyone, nobody would have been working, everybody would have been investing, and everybody would have become billionaire by investing. However, we only hear 60, 70 names as the wizards in the stock market, and that too, they have become wizards when the competition was less. They have become wizards when the regulation was lower. They have become wizards when things were not so organized. Today, in this era, when information is too much, everything is transparent, making money becomes even more difficult. You are fighting practically with the algorithms. You are practically fighting against the AI. You are fighting with the best of the machine learning and the institutions. So how do you make money? The only way you can make money is by two very simple things. First, Be patient. You cannot be a technical investor, because if you try and be a technical investor, someday machine learning will beat your technical skills as well. So be a fundamental investor and have patience by your side. So that's number one. Very, very simple. Number two, what you need to do, is look at, I'm just summarizing the entire gist of everything, whatever I have learned through the years. Remember, cash is real, rest everything is fictitious, and hence cash flows are real, hence everything else can be managed, manipulated, or cooked. So cash flows are real. And how do you figure out cash flows? Very simple. You should look at the cash flow growth, or if you can't find cash flow growth, then you should look at the cash EPS growth. Cash EPS, CEPS growth of last 5 years, and you can get it on any of the websites, any of the market websites. Last 5 years website, year on year, if these businesses are growing at a double digit, just at a double digit, on a constant basis for last 5 years, chances of you going wrong is very, very limited. If you still want to go further, and if you have time and energy, then look at the debt equity ratio. Even if you look at just these two ratios, most fundamentally, debt equity ratio should be less than 0.1 or 0.2, not more than that, because debt is the devil. Debt is reason why most companies land in the insolvency court. Debt is the reason why when things go wrong, companies go bankrupt. And remember, if you lose one business, if you have a wrong business call even once, your 3-4 year returns are gone. So you can go wrong on the stock call, on the stock price call, not on the business. And to evaluate the business, these are the two most basic fundamental. One, cash EPS growth in double digit, Y on Y, for minimum of last 5 years. Last 5 years, the debt should not be increasing. It should, debt to equity should be less than 0.2, and it should be reducing. And if you are there with these two, rest everything is an add-on. Revenue growth, EBITDA margin, etc., etc., etc. But these are the two basic hygiene checks, and if you are there on this, you will not go wrong.
Right, sir. Very rightly said. So, I also want to understand on the point, like when initially start. So, is there any screening criteria apart from these two the figures you just explained there? Is there any other screener which to use, or maybe can be of use to our attendees on the basis of which we identify the companies and later we do due diligence on those companies?
So for us, since we are an institution, so we run many screens, many screeners. We run multiple checks, channel checks, etc., etc. So that's a long journey. I don't want to get into that, because that may not benefit the common investor. However, what you should do if you are starting your journey, start the first step. What you should do is, if you don't know anything about equities, start with basic Nifty or Sensex investing. And why am I saying Sensex or Nifty investing? It's very, very simple. Nifty and Sensex has a very basic inbuilt formula. What is that inbuilt formula? Any company which keeps on losing its profitability, and in turn profitability as well as the stock price converge, the profitability growth and the stock price converge in a period of 3.5 to 4 years. There's never going to be any difference if you hold any business for around 3.5 to 4 years. The stock price growth and the business growth or the profitability growth generally converges. Now, the point I'm trying to make is very, very simple here. If you have that thought process aligned, you should look for businesses which are cyclical in nature. So your starting point should be eliminate businesses which are cyclical in nature. Now, what are the cyclical or the businesses which are not cyclical? Very simple. Banking. Auto is largely a cyclical and auto, but it's interest rate sensitive. But you can, if you are all right to have B2C companies in auto, that's a good thing. FMCG, chemicals, IT, pharma, industrials. These are the businesses which are B2C in nature, business to consumer in nature, and your starting point should be from there after Nifty. So if Nifty and Sensex is the first option, because it, as I mentioned, it has an auto formula where businesses which are not doing poor, which are not doing well, or which are doing poorly, they get kicked out of Nifty or Sensex. So it's an auto built mechanism. So you should start your first step, your first baby step into the journey of investing by investing in Nifty or Sensex. The next step is, if you're all right, you can look for mutual funds, you can look for PMSs, AIS, depending on your risk appetite, etc., depending on your money. But if you don't want to, and if you straight want to jump from Nifty, Sensex into the stocks, then what you should do is look at the sectors which you are exposed to, businesses, biscuits which you eat, the tiles which you use, the paints which you use, the day-to-day items which you are using, the automobile which you use. So any business which is around you, start looking at that. That's the second step. Once you have identified, and you should start with the large cap companies, do not start with the small cap or the mid cap, because those will be unknown names. So start with the known names. Once you have started with the known names, it can be banks, the banks you are banking with. Once you have started with that journey, the next step is put these two filters around them. Once you have clarity on that filter, then you would automatically realize that these are the businesses which we should get into. Once you have decided that, then the next step is buying at an opportune time. Remember, all the time I say that spending time in the market is much more essential and critical than timing the market. However, in the world of algorithm AI, market movement is very swift, very fast, and we saw that on Friday people were pessimistic, on Monday people are extremely bullish. Now this is all to do with the FIIs, and FIIs are driven by algos, by algorithms, AI. Hence what you need to do is very simple. Wait patiently. You would see some bad days when people are selling the stocks which you have selected. You should get in, and you can't time the bottom. Hence, tranche it out. You can tranche it out. If you have some money, tranche it out in 3 tranches. If you have larger money, tranche it out in 6 tranches, and then get into the exposure, and then leave it at least for a period of 2.5 to 3 years, and you would be pleasantly and handsomely rewarded for it. It's a very simple, idiot proof, as I say, philosophy of investing from the retail perspective. Don't get into this hearsay of this stock doing well, that stock doing well. Start from the large cap, start from the businesses which are known. The risk is lower, your understanding will also become better, and then move to the next level of mid caps and then small caps.
Right, sir. So, sir, one more thing I would like to know on this is some sense do initially, or it's a gradual process that we spend some time in the market and over a period of time we hone these skills. And on the top of that, like if say on the basis of criteria which we discussed, we have invested in some companies, right? So, right. So
Right.
then comes like quarterly results and so on and so forth. So how one should get, ideally we, reading the con calls or annual reports, attending the con calls and reading annual reports, because that's a tedious process and people often get turned off by seeing those lengthy annual reports. So how one can, do their due diligence on companies that the thing when they invested is still intact or is improving going forward.
Okay, so very simple. You nailed it, Prince. after you have invested, what you should do is, you don't, if you can't read the lengthy balance sheets, I'm sure it's a tedious task, and people who do not have commerce background, they would find it difficult to read the books of accounts as well. So what you need to do is very, very simple. At least, if nothing else, at least hear the con call or the recording of the con call at your leisure of the business which you own. Now what it will do, and you don't have to listen to the entire con call, just listen to what the management is talking about the future. Now when the management is talking about the future, just hold 3 4 numbers as the key: revenue, revenue growth, revenue projections for the next quarter or the next year. Number two, the profit growth or the EBITDA growth or the EBITDA margin. Or EBITDA stands for earnings before interest, depreciation, and amortization and tax. So, what is that growth gonna come into? These are the two critical things. And third, generally management specifies from where the growth is gonna come from. And as smart investors, or as investors, you would realize if any management is bluffing, or if any management is talking sense. Once you hear one, and whenever you are hearing any con call, please make notes. My request to all of you is, until and unless any knowledge which you are gaining, it is not transformed in your diary or in your notepad or in your digital notes, it's futile, because in next 5 minutes or next 10 minutes, that's going to get evaporated. So what you need to do is, whenever you are listening to con call or any session, please make notes. At the end of the session, there would be 3 or 4 key takeaways. Note that down as the promoter is saying, or as the management is saying. And then when the next call happens, reconcile what the management earlier said and what happened. If it is broadly in line, then it means that management knows what they are doing. If it is way out of board, and if there are no extraneous factors impacting it, so management can't predict if there is a GST implementation, or management can't predict if there is a COVID, I understand, but if there are no external factors impacting the business, and still there is too many derailments in what the management earlier projected and what the management is saying now, it means that there is chaos. And then the first good opportunity you find to exit the business, please go ahead and do it, because the longer you will hold, the longer you will suffer, and you will get into this conundrum of only hope and disappointment.
Right, sir. So walking the talk is one very important, and I agree with you. And apart from that, what all things which we can look in the management? Intent is one which you talked about, and that is that we can do a sanity check by checking the matching the narrative and numbers, right? What apart from
Correct.
that would be beneficial for us so as to identify the traits of the management? What, as per you, would be a good management, and what traits we can look for?
So generally good companies management, they are very conservative when they project any numbers, and they generally tend to over deliver rather than under deliver. So stay away from management which is very, very flamboyant. So that's number 2. Number 3, skin in the game. How much management skin is in the game? Are they selling their equity? Are they buying their equity? Is there a buyback from the management side, or are the individual promoters selling their, pairing their stake? So that is the third key thing. Fourth is, if in the balance sheet, or you can google, if there are any related party transactions which are happening. If there are any related party transactions, then obviously that's a big red flag. If the company is a conglomerate, then you should be particularly worried about, because if there is a conglomerate, then when your left hand pains, then your right hand raises to ease the pain out, and ultimately who's the sufferer? The minority shareholder. Hence, try and avoid conglomerates. Focus businesses deliver better returns, better ROE. Adjacencies, I'm not declining. Related businesses, I'm not declining, but unrelated businesses in the form of a conglomerate, you should avoid. So these are some of the basic tips which you should look into the management. And beyond that is the management also. Some of the good companies make sure that equity is distributed fairly throughout the all the stakeholders, from the lowest strata of the employees to the highest level. It keeps the business motivated, it keeps the business owners motivated, it keeps the employees motivated. So you should look at how is the dispersion of the equity and ESOPs. That's one of the key critical factors as well.
Thank you, sir. So when it comes to capital allocation, as you earlier mentioned that unrelated business investment should be viewed with caution. What apart from that we can, as far as capital allocation is concerned, we can look for?
So capital allocation, so you rightly pointed out, Prince, capital allocation is extremely essential. In fact, remember, in life and in investing as well as for the management or for the companies, there are only two things which are limited. One is the bandwidth, human bandwidth, because everybody has 24 hours, and second is the capital. Now any wrong calculation of any wrong allocation of the capital or the bandwidth means you are going to face disaster. So capital allocation has to be very simple. Capital allocation cycle works in a very simple manner. Capital allocation is utilized to buy human resources or physical resources. Human resources and physical resources sweat to give you revenue, from revenue EBITDA to PAT. But the key thing is, you have to look for the capital allocation where the business is trying to put their more money. Now what does this mean? If any business is doing capex, is it doing capex within the time frame which it has said? That's number one. Or it is exceeding its time limit, because that's one of the simplest measures how the promoters siphon of the money. What do? They increase the timelines of the capex, and by then the demand is dipped, and once the demand is gone, then they write off the capex. So that's a simplest way of siphoning of the money by the promoters through fictitious methodologies. So what you need to do is look at, when you are looking at capex or when you are looking at capital allocation, if they are investing money into people or in projects. So capital can only be utilized into two places, people or project. Now if they are hiring people, are these people making processes, or are they making processes people oriented? Understand the difference. Any human being, if they create process that leads to scale leads to growth leads to market capitalization. And hence, if management is buying or hiring good set of people who in their past have set up processes which have led to the growth of the businesses, that's a very positive sign. Because the the way 1,000 crore revenue companies run, it's very different from the way a 10,000 crore revenue company is run. And to transition from 1,000 crore revenue company to a 10,000 crore revenue company, you cannot only do it by increasing people have to set process. And that's what you have to look, where the money is moving into. If you are getting into, if the management is getting into new projects, one very key element to see is the EBITDA margin. Is the new project gonna deliver heightened EBITDA margin, or it's gonna lower the overall EBITDA margin? Which essentially means, is the overall company's profitability gonna increase by few basis points, or the new project is gonna decline? What sense would it make for any business to have lower profitability with the expansion? Hence, one should always look for businesses where the capital allocation is made with a 3 or a 5 year view, where the margins or the margin, the profit margin of the business can expand in that product range, in that geography, or in that area where the new project is being set up. So that's one of the key critical areas. How do you see the capital allocation?
Right. So, Kaushik, so Karthik, you can go there.
Sure, sure. Thanks, Prince. Thanks, sir, for coming on the platform. Sir, I just wanted to understand every company that is having the cash growth can also be manipulated, right? Is there any techniques to to just to find that is this the cash real or not?
So very, very simple. Any cash which is in the bank is real. Any cash, any sales. So sales can only be so any revenue or sales, whatever word you want to use, top line, sales, revenue, anything. Thanks, Kaushik, for asking this a very important question, because people generally get confused. And I will give you a simple example of it, and it's a very interesting example. Let me first answer your question, and then I will illustrate on the example as well. So if anyone is looking at revenue or sales or top line, there has to be a contra entry. You just cannot have sales, right? So either the sales has to be in cash, physical cash. That is not possible in the modern day, because government has put very, very tight limits. So there can be only one thing. Either the sales has to generate the bank balance, it has to increase the bank balance, or the second methodology to do this is to increase the receivables. That's the key thing to watch out for. Is the receivable days changing quarter by quarter? Some days when the receivable days are 69, and sometimes the receivable days are exceeding 121 or 181. Remember, typically, if once the receivable days exceed 93, 94 days, that receivable ain't gonna come. That's a fictitious or the bogus sales which has happened. So also the changes in the receivable days indicates that the company is manipulating its sales. On the other side, if that is generating cash balances, cash means in terms of bank balances, that's real. You can't escape away from, if the bank balance is real, the market will handsomely reward for that. So that's number one. But let me illustrate a very simple example. Why do people do fictitious sales and increase the receivables? It doesn't make sense, right? Because if I do fictitious sales, my operating profit will go up, and hence my PBT will go up, profit before tax will go up. But if the profit before tax goes up, I have to pay tax on sales which has not happened literally. It doesn't make sense. I've not sold something and I'm paying tax on the gains which I have not sold. What sense does it make? Now let me explain to you why do smart promoters do it. So let's take an example where somebody does a sales of 1,000 rupees, and then the operating profit increases by 500 and the PBT increases by 100. Profit before tax is it jumps by 100. Now the company has, and imagine the owner's equity or the promoter's equity is 50% in that company. So I'm repeating the example. 1,000 rupees is the bogus sales, 500 is the operating profit, 100 is the profit before tax, and in this company the promoter's equity is 50% and 50% is with the public. Now why would the company pay 25 rupees of bogus of tax on the bogus sales? There is a reason behind it. When you pay 25 rupees, your PAT comes at 75 rupees. What is market capitalization? Market capitalization is not directly the PAT, it is a multiple of PAT. So imagine if the company is trading at P multiple of 20 times. So how much your market capitalization will increase? 75 multiplied by 20, which is 1,500. In a sense, if the promoter's equity is 50%, which means 750, and 25 rupees of tax, which means the promoter's share is 12 and a half. So by paying a fictitious or a voluntary fictitious tax of 12 and a half rupees, the promoter is adding to his market cap 750 rupees. That's the logic why people do bogus sales. So very, very relevant question, Kaushik. Thanks.
Sir, this was a very deep concept. So it was like for paying the 50 rupees taxes, the company owners are actually increasing their net worth and they can actually pledge.
Correct.
So
Correct.
there are some examples, Indian examples. Like I think everyone should look for those. These are like comic stories. So everyone should look into this. Sir, another question that I have it on is that do you believe any price, great quality at any price, or what is your philosophy on that side?
So, Kaushik, would you buy gold at any price? Would you buy 10 grams of gold at 1 lakh rupees, or
I
would
would
you
not
prefer?
do that. I
Correct.
would not do that.
Correct. So what you need to do is very, very simple. You can't buy any stock at any price. Very simply. So if I have to go deep, little bit deep into the investing journey, then what you need to do is look at very, very simply, not the price to earning multiple of competitor or the peer group company. What you should do is look at the company's history of the price to earning multiple at which it has traded in the past. Let me give you a very simple example. If you make, so running is a sport, marathon running is also a sport, and sprint running is also a sport. Most people get into this confusion that whether I should buy because this other company in the same industry is available at cheaper price, why is the other company is available at a expensive price? Now think about it. If you make a marathon runner run 100 meters in 10 seconds or 11 seconds, 9.5 is I think the record, the person would die. And if you make a sprint runner run 20 kilometers or 40 kilometers in 1 hour, he will die. So the idea is, what you should do, instead of comparing, you should look at the history, last 3 years, 5 years history of the price to earning multiple of the same company. At what price to earning multiple has it been trading? What has been the mean? What has been the dispersion from the mean? If it goes beyond the confidence level of 20% or 30%, it is expensive, it is gonna come down. And if it moves beyond that, book profits. Because remember, generally what market tends to do, one good quarter and market starts anticipating that next 10 quarters the company would grow exactly what the one good quarter numbers look like. That's never the case. If there is a high jump because of an extraordinary event or extraordinary reason, it is going to revert to the mean. And then you constantly see either time wise correction or the price wise correction, and that's both detrimental to equity investing. So sit patiently, the price will come, there is no hurry. Remember, your cash should be ready when there is chaos in the market, when there is confusion in the market, when everybody is exiting, you should enter the market. So don't buy in a hurry. And as I mentioned, never be out of the market completely. So what you should do is always tranche it out. So have 4, 5, 6 tranches. At least one tranche should be there as the starting point, and then keep averaging whenever you get the right opportunity. If you don't get the right opportunity, there are times when you miss the bus, so be it, it's all right. You have enough and more good quality businesses which you can enter.
Just on
Got
your
it, sir.
averaging, so the house is divided on upward averaging and downward averaging. So what do you prefer and how you make a segregation which fits in which point itself?
Sorry, Prince, I lost you, your voice cracked. Sorry, you was talking about the cost averaging. I couldn't get the.
Am I audible now?
Yes, little better. Yes, little better.
I was asking like the house is divided in the sense some people prefer upward averaging only, and there are
Hmm.
times when good companies are available at a cheaper price, so downward averaging is also advisable. But do you? I mean, is there any segregation on this point, or it's all situation? What situation we are in, and how one should go about it?
I would always suggest that any good quality franchise which historically has been doing well, if it meets with an accident, buy it immediately. Remember, accidents seldom happen, but they do happen with good franchise. It has to happen with everyone's life, in everyone, irrespective of who you are. You can't avoid the downturn in your life. And same thing with good companies, and the same thing with investing. But when it is there, put more money behind it. Things are so that's the reason the character of the company, when you look at the first two ratios which I spoke about, the consistency and the cleanliness, if you are able to assess the character of the company, and when things are going bad, put double the money there, because that's when the bounce back would happen and you're going to make tons of money. So I'm absolutely in favor of, when things go wrong for a good high quality business, double your bets.
Prince, can I take one more question? Yeah. Sir, another question that I have it, if you remember, like we had extensive talk over this, like there are a lot of companies who actually do show their taxes in their P&L statement, but they not show that in the cash flow statement. Like how do you go through this, like this ratio that we were talking about is cash tax divided by income tax should be greater than something like 60% we have spoken.
Right.
How this ratio would figure out, and if you can explain about this ratio to everyone.
So very simple. Remember, if so, income tax or any other expense, it has to be routed. Everything has to be routed through the P&L. Very simple. There are a lot of companies which directly capitalize the expense. That's the wrong way of doing it. So that's number one. Number two, when you are looking at income tax, or the tax payout, the higher the tax payout, the better it is. Because remember, more and more companies, they generally, and if you look at most of the minority, so in the large cap you would not see the ownership, the promoters ownership going up to 70-72%. Generally most of the businesses there, they have lesser ownership. And if the company is paying relatively higher taxes, it's very clearly means that the sales is relatively ethical. But however, as I mentioned, the best way of doing and checking this is through the cash flow methodology, rather than through the income tax. Because as I mentioned in my earlier conversation as well, that the price to earning multiple camouflages the intent of the income tax as well, the paying the income tax as well. So I would rather go by the cash flow methodology rather than only looking at the income tax. And that's the reason the cash conversion ratio, which means how much of the sales is actually getting converted into the bank balance, is the key rather than any other ratio.
Thanks for that, sir. Sir, is there any in your experience in your career lifetime, like is there any experience that company stood at every point that you are looking at, but still pointed out to be an fudge company? Something you have an example like this?
so so there are smart cookies who exist everywhere. There are smart cookies who exist everywhere. But generally cash manipulation is relatively lower. Cash manipulation in the bank is relatively lower, because somehow you have to generate cash, and then how do you manage that cash? So unless you have some sister concern, you have some unlisted company which is doing the which is doing the maximum expenses, and here you are booking the sales, that manipulation can happen. However, that's the reason you also look for the conglomerates, because generally that happens in conglomerate where three non-aligned businesses and one business takes the hit of the expenses while the other business takes the cash flows. So something of that sort happens, but also you can avoid it by remaining focused capital allocated businesses. So that's what however, you still cannot foolproof remove it from the intent of the promoter, because what if through the capex methodology, by appointing fictitious suppliers, fictitious you can still manipulate little bit. It's difficult with the GST implementation, it's difficult from the taxation laws, but still it can't be ruled out. In my career and in my life, I have seen quite a few companies who have done that, but increasingly in last 3 4 5 years, those situations and those things have been curbed down dramatically. In fact, that is one of the reasons why a lot of businesses actually die from the exchange. They literally die. So India has the largest number of listed companies, if I look at between BSE and NSE, if I remove the overlap, and there's a significant number which die every year. And hence, as you have rightly pointed out, Prince and Kaushik, that the key in Indian investing is safety first, protecting your capital first, because growth is going to happen in a high inflationary and a high growth economy like India for years to come. But the key is to protect and preserve your capital, not to lose capital to bogus promoters. That's very, very essential.
So, Siddharth sir, how you see aggressive accounting, which is, by law not illegal, but again, not very good thing we can say that. So, what's your view on that?
Sorry, I lost you, Prince. I lost a few
I was
words of
talking
yours.
about aggressive accounting. How you view this?
Right. So aggressive accounting at any cost should be avoided. Should always be avoided. Lot of small sized companies, newly listed companies, they do all this aggressive accounting. But I would strongly against it, and I would strongly discourage people to get into their scam or into their accounting. Generally leads to disappointment in 3 to 4 quarters time. And as I mentioned, now is the world of algorithms and artificial intelligence, and most of them are fed with the data of the estimates. These data come from the Bloomberg estimates, these come from the different video channels, or from the various TV channel estimates. And when there is a disappointment, then automatically the cuts or the drawdowns are very, very significant. So I would rather suggest that one should avoid with aggressive accounting altogether, rather than taking it as a short term phenomenon.
Right, sir. So, sir, you have your expertise, or you prefer sharing knowledge on behavioral finance. So, I would appreciate if you touch upon the nuances, and that would be really helpful for everyone around, so as to know how we can manage our behavior well, or secondly, on top of that, how we can improve our decision making, which is very important in the market.
Okay, so very, very simple. I will give you a very simple example. Imagine you have invested 1 lakh rupees in two stocks, stock 1 and stock 2. Stock 1, and you have invested it for 2 years. After first year, after 2 years, and one stock A became 1 lakh to 2 lakhs, and the second stock became from 1 lakh to 80,000. Now you have already spent 2 years, so you have already spent roughly around 8 quarters watching the stock behavior. Now imagine if your spouse wants 50,000 rupees out. So you have invested 2 lakh rupees. Currently you have got 2 lakh 80,000 rupees as the value, and your spouse wants 50,000 rupees out to be gifted to her or him. What are you going to do? most people most people would exit from stock A, which has become 1 lakh to 2 lakh, and the second stock they would keep holding in hope. So what do? We keep cutting the legs of our fastest horses. This is also the theory of endowment effect. This is a cognitive bias. And what does it say? That we constantly keep believing that whatever we have eventually is very, very precious, and we can't let go. And that is one of the reasons why most people, or most men and even women, they may have 30 pairs of shoes or 30 pairs of dresses, but they end up wearing only 2 or 3 or 4 pairs, and rest of them are stacked. Similar thing happens with the books. You may have 50 books, but you end up reading only 4 or 5 or 7 books. Rest of them are there because you believe that, and you don't want to give it away. You're not going to use it, but you don't want to give it away, because whatever you have, you feel it very, very valuable. So that's one of the very, very basic concepts of behavioral finance. So there are multiple behavioral finance concepts which impact the decision making. Another one is, we try and generalize every information. What does that mean? We have a bias. We have anchoring bias. So what does this mean? So imagine there are 3 stocks: stock A, stock B, stock C. I am researching all the 3 stocks: stock A, stock B, stock C. Now my friend Kaushik and my friend Prince told me that stock A is doing phenomenally well and it's going to do phenomenally well. That's about it. He has not quantified, he has not said anything. And when I'm doing the research, my mind is obviously cluttered with a lot of data. There's a lot of data, as you mentioned in your earlier conversation. So my mind will jump to conclusion. And I would say that broadly stock A, what Prince and Kaushik also said, look decent, and hence I would jump to conclusion that stock A is fine. Why should I make my brain tired with a lot of information? Remember, it's very, very interesting. Why does brain do this? So understand the concept behind it. Our brain weighs only 8 to 9% of our body weight, any human being, but it consumes roughly around 30 to 35% of our energy. And hence, from the hunter-gatherers time, when the human evolution happened thousands of years back, at that point in time, every time if you have to gain energy, you have to hunt or you have to pluck, which required even further energy. So what the mind says, what the brain says, that's conserve energy. And hence, if you research more, then the brain would say, why should you do this? Whatever others are saying, just stick by it. Ultimately, they are your friends, so rely on it. And that's how we get into this anchoring effect or the bias. Similarly, if somebody says negative about it, irrespective of the numbers, irrespective of the data, you would tend to not invest into it because you would always have that thought process. So these are, and there are several other biases. I can go on and on, but this is the way mind works, and this is the way behavioral finance works. Also, we never, the reason why we don't invest in equities is because, despite of having, so think about it. Let me give you a very simple example. You invest in a bank. Now, what is the business of the bank? Very, very simple. Borrow money in the form of deposits and lend money in the form of loans. Borrow money in the form of deposits and lend money in the form of loans. Most people believe that fixed deposits are safe. So imagine if somebody is investing 10 lakh or 20 lakh rupees as the fixed deposit. Now, RBI or the government of India only through the insurance gives you 5 lakh as the insurance cover on your deposits. You have invested 20 lakh rupees in the deposit. Now, if the bank continues to do their due diligence well, which means they continue to price their credit well, ensures that their recovery of the loans which they have given well is is in order, then the margin and the profitability of the bank will continue to grow multifold. On the other side, if there is mispricing of the risk, and if there is default, if there is constant default, then what would happen? The bank's loans would not come back, and when the bank's loan will not come back, if the credit insurance or the insurance on the deposit is only 5 lakhs, then you are exposed to a risk of you losing your money up to 15 lakhs. Now, in a 1 year period, the bank stock can be volatile, but in a 4 year period, or in a 3.5 4 year period, if the bank continues to deliver the margins well, continues to progress well, in that scenario there is practically no risk, because if the bank continues to ensure that the credit pricing is well, NPAs are not there, or NPAs are minuscule, and the credit writing and the loan offtake is reasonable, and the loan recovery is reasonable, then your deposit is safe. If your deposit is safe, then the margins or the difference between the loans and the deposit is there, and that's how you make more money on equity. So the risk, so people generally believe that risk is higher by investing into the same equity of bank A versus investing into the deposit. If you hold for a 4 year period, I practically believe the risk is the same, whilst returns may differ by 3x. So these are some of the fears or the biases which people have. Another thing, people believe that equities are risky because they can't see equities. Also, people believe that equities are risky because they can see the price of equity every day. However, when they invest in real estate or when they invest in gold, they don't see the price every day. Now think about it. The conundrum is, the oxymoron is, as soon as you buy any property, you are down 8 to 9% immediately the day you purchase a property, because you will purchase the property at a market price. Nobody is going to sell you at a discount. So if you have bought the property at the market price, immediately, by paying stamp duty, by paying the registration fee, by paying the broker's fee, by doing up the house, you're already under 8 to 9%. And you are not worried about it, because then you say that I am going to own the property for next 3 years, 5 years, 7 years, 10 years. Whilst when you invest, you start looking in next 1 month, hey, look, I'm down by 3%, I'm down by 5%, and my heart starts beating fast. So that's the behavioral part of investing, because beyond a point, it's not your IQ, but your EQ, emotional quotient or emotional intelligence, which plays a vital role in investing and in winning in equities, rather than the plain vanilla, just the knowledge part of it. So these are some of the examples. Maybe more we can take it later on.
Right, sir. So initially in your opening note, you talked about India's growth story. So would like to understand from you how we can ride the India growth story, and if I were to ask you on ground situation, so how things have panned out in last almost a decade from 2014 going forward. So, and where we are heading exactly, being a youngest country in the world with almost 70 crore people who are in the working age. So how you see it going from here, sir?
Not only 70 crore people, Prince, it is 65% of the total population of India. So it is 42 crores. 65% of the population of India is between 15 years to 59 years. So you're absolutely right. We are on the cusp of the demographic dividend. But before I move on to the demographic dividend, let me tell you your first question, which you asked about the India's growth story and the India's growth trajectory. So for any economy to prosper, remember there has to be spending. Spending leads to demand creation, spending leads to income, spending leads to jobs, employment, and the investment cycle, and so on and so forth. So that's the cycle which continues. In any economy, which is the largest spender? Who spends the maximum money in any economy, whether it is India, whether it is US, whether it is any other, whether it is China, whether it is Russia, any economy? It is the government. It is the central government which spends the maximum money. Till about a decade back, till about a decade back, most of the money, so till today also the largest spender in the economy is government of India, and earlier also it was in government of India. However, earlier there were three derailers which were causing massive leakage, which was causing massive leakage in the spending of the government. What were those? Number one was intermediation. Number two, corruption. Number three, crony capitalism. Now let me explain to you what is intermediation. So all of you have heard about Manrega. It was very classic that large part of the Manrega, which is almost 90% or 92% of the total Manrega spend, was going to the intermediaries rather to the end beneficiary. What government of India did? You are asking about the ground reality. I'll give you some data points here. So till about 2013-14, there were 25 crore bank deposit accounts which existed in India. 25 crores. Today, in 9 years, it is 9 times. 9 years, 9 times. It is 225 crore bank accounts. And the interesting part is, one third of it, or more than one third of it, almost 79 crore accounts are owned by women. Are owned by women. So this is what has happened. With the opening of the bank account, there is direct benefit transfer. We all know about DBT. So that has curbed, that has nipped the leakage in the system from the intermediary perspective. Second thing, which is the corruption. Now corruption generally happens from two very specific reasons. One is higher taxation. When there is higher taxation, then you would tend to avoid tax, then you would try and evade tax. Then the second, multiple taxation regimes, fragmentation of the taxation from one state to another, from one geography to another. It leads to confusion, and the confusion leads to corruption. What government did is implemented GST, and we all know the GST per month figures, month on month. Third thing, crony capitalism. Now think about it. During the previous regime, there were a couple of families which were getting immensely benefited. Today, let me tell you that the biggest tech globally is owned by private companies. In India, the biggest tech, the most profitable tech in the country is owned by government of India. So whether it is Covin, whether it is UPI, whether it is RuPay, all of them is owned by government of India, which means private parties are not getting benefited. Plus, you would be surprised that most of the high-tech manufacturing, whether it is submarines to the drones to the green hydrogen to all the newer things which are being manufactured, they are not being done by established groups. They are being done by the private limited companies, the smaller companies. Now what does this mean? It clearly means that there is widespread innovation, and smaller businesses are getting immensely benefited out of it. So that's number one. Number two, how does also the economy leaks? Economy leaks when you have significant amount of imports and then you use the imports and then you don't use them for exports. That's number one. Number two, you do a lot of infra spend and defense spend. Infra spend converts into cash and that turns into black economy, and defense spend, that's again is sent outside, and you buy junk from outside, or you even buy sophisticated material, sophisticated weapons, but maybe at 3 times the price, the 5 times the price. So these are the typical ways how the economy leaks from the largest spender, from the largest spender, which is government of India. What government did? It so the defense budget remains. So if you look at the this year's budget, 1.9% of the GDP. It's a phenomenal number, because the GDP is at its peak, all-time peak, and 1.9%. And historically, the defense budget has been 2.12%. Now, large part of that, almost as high as 40 to 45%, and in future maybe 60 to 65%, is gonna be utilized to manufacture that defense in India, which means Indian government is benefiting Indian businesses rather than sending the precious spend in the form of dollars outside. So that's there. Second is infra spend. We all know how the velocity or the speed with which the road construction and the infra spending is happening. Never in the history one has seen an unprecedented 4.5% of the GDP, such a large GDP, and 4.5% of the GDP being spent on infra. The last one which I mentioned is about gold. So still some bit of the money is going for the gold imports, but through the sovereign gold bond issuances, the government of India is trying to nib even that demand which is from the exports, because these are the ways where physical money, the money of the country, goes outside. And if the money remains within the country, it creates demand creates investment creates job creates income further creates demand. That cycle perpetuates. So this is the simple cycle which has got turned around since 2014.
So coming to the demographic dividend, how we can leverage it so as to drive our economic growth?
So very simple. We are already doing that. So Prince, if you look at, we are already doing that. So demographic dividend plus, so there are 3 Ds. There are 3 Ds of Indian economy which you should always remember. One is demographic dividend. Second is digitization, digital enabler, and the third is democratization of capital. So look at time, between from before 2010 2011. Look at all the periods. How many people used to have capital in their hands to start any business? Very select few. If you are in the close coterie, either of the politicians or the bureaucrats or the bankers, then you can have access to capital. Now, today there are 30 people who are queuing up to give you money. At that point in time, 30 people were there begging to enter the bank for the loan application. So how things have changed. So that's number one. Number two, digital. So whether it is education, whether it is healthcare, whether it is money movement, instant money movement, 58% of the global instant money transfers, 58%. India comprises of only 140 of 800 billion people. So roughly around rough and ready, closer to 17-18% of the total population. However, 58% of the total instant payment transactions happened in India in the last financial year. So digital education, you have seen the number of participants who have multiplied, the quantum of SIP, the quantum of equity investing, all that thanks to the digitization. The reason why Prince is able to share the knowledge through a simple conversation is through the technology. So this is the way the second enabler of digitization has helped. By the way, ladies and gentlemen, just to give you a perspective, India consumes 2.5 times more data, 2.5 times more data than the entire data of China and United States put together. So you can imagine the kind of data which India is consuming, and there are hundreds and thousands of businesses which are revolving around the internet space. Now coming to our first point, which is the demographic dividend. Demographic dividend is the key, and demographic dividend is paying very handsomely. Let me give you some examples of the past. China, China, which I'll tell you what demographic does to your country. People believe that demographic dividend is a small thing. It's a mammoth. It's a gigantic. It's a phenomenal thing which that can happen to any country. Japan, after the Second World War, everybody knows roughly around 30 to 35% of the total male population got decimated. 1944. Then there was a baby boom, and then the next generation came. In next 20 years, the demographic dividend started in Japan. 1964. That lasted for next 40 years. And imagine the size of the economy. We all know that 70s, 80s, 90s was the time when Nikkei went all-time high. The Tokyo real estate prices were all-time high, even more expensive than any other real estate piece in the world. And the Japan's economy moved from $80 billion. Ladies and gentlemen, note this number down. $80 billion to nearly $5 trillion, 4.89 to be precise. 80 to $5 trillion. It is nearly 500 times, 500 multiple in a span of 40 years. That's what demographic dividend does. Second, I'm giving you an example of China, our neighbor. China was impoverished. China was not amongst the top 10 economies. Today it is the second largest economy behind United States of America, having roughly around $19.5 trillion, the second largest economy. Their demographic, they had a massive famine. They lost roughly around 22 lakh people in the famine, one of the most disastrous famines in the history of China. 94 they started to have their demographic dividend, which means the younger population was large, and their population is gonna enjoy the benefit of demographic dividend till about 2031. And we all know what China has become in last 2 decades. So from a $564 billion, today they are $19.5 trillion. So 1994 they were $564 billion. So you can imagine 40 times merely in 30 years. So that's the growth which they have seen. India is currently at 2.6, 2.65, 2.7 trillion dollars, and it is poised to hit the $10 trillion mark, which means it is gonna become the third largest economy by 2033. And India's demographic dividend actually started only in 2017, 2018. It's gonna last till 2057. So this is really the Swarnim era. This is really the golden period for India, and it's gonna last till about 2051. The population growth and the younger population growth is gonna remain robust after 2051. Then it's gonna start declining, but the demographic dividend is gonna remain till 2057. So one need not be worried about the income growth, about the consumption, about the business, about the demand. One needs to be worried about how to play safe and then grow the money. So this is what the demographic dividend of India looks like. Hopefully, as I mentioned, by 2047, 2050, India will supersede China, or will be equivalent to China. China anyways is expected to supersede United States of America in next 8 to 10 years time frame. So that's what is going to happen.
Coming to a very important question, which our attendees also always look for. So, which pockets you think at this point in time are investable? Although we as a country are growing, and if you were to make choice of top 2, 3 sectors, which would be those sectors and why?
So very, very simple, Prince. I always believe in consistency and resilience, which means the demand should not die down. Unfortunately, infrastructure, capex, I spoke about a lot. However, it's cyclical. What if the government slows down? What if the fiscal deficit of the government, does not permit it to increase the infra spend? And anyways, if that next year is the election year, I'm sure nothing untoward would happen. But after the election year, the infra spend may come down if the fiscal responsibility bill act which comes into play, which means that the effort, which means the fiscal deficit is going to reduce, then infra may take a little bit of hit in the forthcoming year. So what you should do is play very simple. Play sectors like banking you cannot, because what blood is to the body, money is to the economy, and hence if any economy has to grow, the banking sector, the financial sector has to multiply multifold. So banking is something which I would suggest very strongly. FMCG, again, resilient, small ticket size, consumption upward trajectory, the lower end consumption to a higher end consumption, higher value consumption. So FMCG is one of the places, and FMCG is going to do extremely well because the costs have reduced. The inflation is allowing the FMCG companies to reprice their products well, and demand remains robust, and hence FMCG is going to make tons of money. Chemicals, pharmaceutical, and IT, all three of them have been beaten down. As the income levels rise, the pharmaceutical has to do well, healthcare system has to do well, the longevity of life has to do well. IT, we can't live without. IT and IT services have to do well. Again, earlier there used to be roti kapda makan. Today there is bijli, sadak, pani, and Wi-Fi, and Wi-Fi is the key. And hence IT has to do well in times to come. The last but not the least, chemicals, I believe, when you get up in the morning, you brush your teeth, you wash your hands with soap, both require chemical. When you sleep, you put a mosquito repellent, that also needs chemical. So every part of your life is impacted by chemicals. So chemicals as a sector, and at this point in time, chemicals as a weightage in Nifty is only 0.7, 0.8. Exactly a similar thing happened in 1996, 95. The weightage of the public sector banks in Sensex used to be as high as 25-26%. Today it is less than 3.5%. Private sector bank used to be at that place 3.5%. Today the private sector bank is at 25-26 odd percent. And this is what is going to happen in decade, when the chemicals weight in Nifty itself, which is 0.7%, may rise to 8-9% in a decade or so from now. You would see a lot of chemical companies moving handsomely. So that's another big call which I have. Auto is seasonal, auto is temporary, but I think there is an opportunity to be made, money to be made in next 2-3 years, because there is huge pent up demand after COVID, and I'm very sure that good auto businesses for next couple of years are going to do well. But it's not a resilient, it's not a completely acyclical business, because higher the interest rate, the propensity of people to buy autos reduce. But as the urbanization increase, so currently the urbanization in India is closer to 34 odd percent. It's poised to become 40 odd percent by 2030, and as the urbanization increases, the auto demand is only going to grow from here. So these are some of the sectors. Industrials, as the government's Pradhan Mantri Awas Yojana, through which nearly 2.5 crore houses have been already allocated, and there is another 3 crores in the annual. If you have a house, you would need textile, you would need hosiery, you would need bathroom fittings, you would need curtains, you would need tiles, you would need fans, you would need anything, you would need furniture. So anything and everything would be needed. So all these are evergreen sectors, as long as you are able to buy it at the right valuation and look at the businesses which are investing the surplus cash flows back into the business and not siphoning off, you have tons of money to be made.
Right, sir. So, coming to the very important and last question from my side. So, we all make mistakes, right? So, your journey of past more than 2 decades, you must have made plenty of mistakes.
Correct.
So, any few of them you would like to tell our attendees so that we can learn from, as it is always advisable to learn from the mistakes of others so that we do not commit the same mistakes, right?
Right. So the first mistake which you said, which Kaushik asked me as well, uh, earlier I also used to believe, and I made quite a few mistakes there, that any business, any fast growing business at any price is a is a welcome boon. But that's one of the mistakes which I realized, and then I corrected that not everything can be bought at any price. So that's one mistake. Number two is, irrespective of how much you do research and how much you do channel checks, how much you try and figure out from the board, from the employees, from everywhere, the simplest way to analyze the company is ultimately to figure out the past track record or the character of the promoter. Because if the promoter is not clean, irrespective what the company has delivered, the promoter would want to try and siphon off the money. Now let me tell you a very simple example. When times are good, promoters generally put a lot of money into the company, and then they grow the market cap, and then they place the equity. But when tough time comes, then they start chickening out. And that's what is the key. If you Unless you judge the promoter quality well, you will never end up making money. Hence, it's very, very critical that right quality of promoter with the right intent you have to find, and it's difficult. And hence, when I spoke about the con calls and the walk the talk which you spoke about, Prince, that's the key. Because uh, promoter quality is one of the key items which drive or which protect the minority shareholders interest, and which drive returns. So that's another mistake which we realized. Number three is that you wait too long. You wait sometimes too long for the price to correct. But then we realize that buying in tranches, buying in small bits and pieces, and then building up the position slowly and gradually makes sense. Because otherwise you'll keep waiting for your price. So I'm not saying that buy at any price, but also I'm not saying that you keep waiting endlessly. So you have to take a small position. So the first and the third, there has to be a balance. I said the first thing and the third thing, so there has to be a balance between it.
Right, sir. And like before we close the session for the day, it would be great to hear some recommendation on good books or literature on market from which we can benefit.
So I would suggest that you should not read any market related books. You can read the psychology of money. You can read Good to Great, etc. But more importantly, rather than reading anybody's perspective on behavioral finance or on money or on finance, what you should do is read about businesses in the story. So if you read how the McDonald's was built, you can read about how Nike was built, and there's an interesting movie which is coming on Nike. So I would suggest that read about how great businesses are built, rather than reading what to do and what not to do. Because when you understand how great businesses are built, then you would automatically start learning how to invest into those great businesses. And unfortunately, not too much is written, barring Tatas. Not too much is written about how great businesses are built. But you can pick up a lot of western books which are there, how great businesses are built. And just pick up any business, how these businesses have grown over a period of time, and you would enjoy reading them and then learning from them.
Right, sir. So one quick question which came to my mind. So you talked about fundamentals. So does technicals find any space in your process of investing?
Unfortunately not. Unfortunately, not too much, but we look at, especially in the small cap investing, we see the price correction because and if there is a sharp run up, you automatically know that there would be a price correction. So there would be a band, but beyond that, every stock price moves in a particular band generally. And if you are able to just look at the data for last 1 month, 2 months, 3 months, 4 months, and you'll be able to figure out the band of the price of the stock. So you don't have to be a wizard or a very knowledgeable person to figure out the technical analysis. Just understand the band, and you should be through. If you are able to even buy it 10-15% from the above the bottom, which is the band bottom, then you would be all right. Because remember, what you have to always think through is the margin of safety. When you are investing, you always have to look for the margin of safety, because if you buy at the top, your margin of safety is going to be almost zilch. So you have to maximize your margin of safety, and your returns will come automatically. That's all you have to do.
Right, sir. So, Kaushik, before we close, anything on your part?
Yes, yes, Prince. Last question, sir, if you don't mind. So I just wanted to you have created such a strong philosophy in your organization, and that shows in your historical numbers in the performance. So can you give in a snapshot what are the elimination criteria, because all the 5,000 companies I cannot go, and it's that you have to mention that going on the cash EPS is the more preferable way. But is there any set of this thing that if we put a filter and then we get out the list of the companies,
So what
something like that?
so what you can do is you can have a couple of filters. So one is obviously the revenue growth. So you can have a double digit revenue growth, or low double digit to a high single digit. If you keep that as a parameter, because if the company is growing between 8-9% to a 10-11% y on y for last 5-6 years, that should be all right. So that's number one. Number two is the as Prince also mentioned about the capital allocation, and that's what brings the ROC, return on capital employed. So if that number should be higher than the return on capital employed should be higher than the cost of debt and the cost of equity. Now the cost of debt now it has gone higher, but otherwise the cost of debt in the country is around 10-11%, and the cost of equity has to be 100-200 basis higher, so 13%, 14%. So if you are just marginally above the cost of equity, which is 13-14% for the similar period, 5-6 years, I think that's a good number to watch for. The third one, which I said, is the cash EPS growth. So that's a very critical number. Debt to equity is again very critical number, less than 0.1, 0.2 debt to equity. So if you put these filters for last 5-6 years, you would be fairly left with mini skewed set of numbers. So you'll be left with maybe 1% of the companies, or 2% of the total listed universe, and that's where you will start the fundamental research on. So I would strongly urge people who have interest in this space should start working on this data, and you would find very fascinating results around them.
Right. So when Kaushik asked this question, other question important, which is very important, came to my mind. So selling is something which comes with regret, and not many people can master selling. And obviously, it's about we cannot time it to perfection. But again, what are your criterias before selling a position?
So selling a position is very simple. As I mentioned, while buying the same thing and selling the same thing, when the stock. So I told you about the P multiple mean and the dispersion from the mean. If the P multiple crosses that dispersion, the comfort zone, then you obviously don't buy. But if it crosses, then you want to book profits, because if it is 70-80% higher than the average mean, then you automatically would want to exit that business and book profits, take away the profit from the table. So that's number one. Number two, you saw that your thesis was based on the process, on the cleanliness on the certain criteria, and then you automatically see a red flag coming through, because there is a change in management, there is a change in the philosophy of the company, there is a change in the ideology of the company, or they do something which is not in coherence with the past track record of the management. Then automatically you tend to exit. Wrong capital allocation is one of the reasons why we would exit. Number 4 would be, you see visibly that the sector is going to be out of fashion because of certain reasons, because of the certain headwinds, because of the certain geopolitical reasons. Then you would want to get out of it. Promoter skin in the game is constantly reducing, you are worried about it, and then you would exit. So these are some of the reasons. One is the first one, or the first couple of them are with regards to the profit booking. Rest of them, you just take the call and exit, irrespective of where you are on the profit or on the loss line. So irrespective of whether you are making money or not making money, you still have to get out of it.
Right, sir. So thank you so much for your time and wonderful insights explained brilliantly. And thank you so much for Kaushik to so as to ask questions as well and bringing sir to this forum. So thanks, Kaushik, to you also. So Siddharth sir, like we couldn't take many questions from the attendees today. So it's already 2 hours. So and perhaps we can have sometime down the line to your convenience another round in which we take questions from attendees only. So with
100%.
this, yeah. So with this, I thank you from the bottom of my heart. It was really insightful and a different perspective altogether. And for our attendees who joined late, the session is recorded, and as and when I get time, so I'll be placing this recording over my YouTube channel so that you can revisit the insights shared by Sir. So thank you again, and good night, guys. Shortly we meet again. Take care. Good night.
Thank you, Prince, and namaste to all of you, and Jai Hind.
Thank you, sir. Jai Hind.